The importance of consistent investing cannot be overemphasized and should never be downplayed. In fact, if you're not an ardent investor, then you are missing out on the power of compounding interest, which is one of the fastest ways to attain wealth. As Ben Graham puts it, the individual investor should act consistently as an investor and not as a speculator. Well, I know for sure that investing in stocks and ETFs is one of the best and efficient ways to attain these goals. In this video, I'll be talking about my top 5 Canadian stocks which I'll be buying for the rest of 2023. Hey everyone, this is Ebuka and this is the Finance Biz channel. So if this is your first time on this channel, please feel free to like, share and subscribe with friends so you don't miss out on the gems I'll be sharing in this video and in subsequent videos. So this channel majorly focuses on topics around income generation, savings and investments, debt management and overall financial freedom. So I've carefully selected 5 amazing Canadian stocks which I'll be buying for the rest of 2023. These stocks were selected based on several criteria which I'm going to be sharing with you as quickly as possible. So my criteria for selection includes number 1, industry performance, number 2, the kind of services they provide, and number 3, financial statement analysis. So my first stock is Sun Life Financial, which trades with a ticker symbol SLF. So Sun Life is a Canadian financial services company majorly known for its life insurance services. It provides a broad range of services which includes insurance, wealth, and asset management. Sun Life currently oversees assets worth 1.3 trillion Canadian dollars across different countries, and its headquarters is based in Waterloo, Ontario, Canada. Now let's take a quick look at Google Finance to see what its performance is before we go into deep analysis of this stock. As you can see from Google Finance, Sun Life Financial Incorporation trades on the Toronto Stock Exchange at the price of $69.02. It has a market capitalization of 40.57 billion Canadian dollars. So I actually did a quick analysis of Sun Life financial reports. Now the dividend yield sits at 4.35% averagely and a growth of 9.09% per annum and a 52.37% dividend payout ratio. Now when you compare that to the industry average, you can tell clearly that this is performing at a very reasonable or good rate compared to the industry. Now if you take a look at the dividend yield of 4.35%, if you are to invest $1,000 in this stock at the current share price, you should be getting 43.50 per annum, which is pretty reasonable for an average stock. Alright, now when you look at the dividend growth, it's pretty close to average, and then the business reinvests most of its profit because you can see that 52.37% is what it pays out as dividend currently. Now when you take a look at the current ratio, it sits at 49.82, which is pretty close to the industry average of 54.29. Now this implies that this is healthy liquidity of the business and the ability to pay short-term liabilities as at when due. So the downside to excessive liquidity is the lost investment opportunities and the returns you would have gotten from those investments. Now let's look at the quick asset ratio. So the quick ratio is 45.71, which is above 25.39. This shows more liquidity, of course. Then we have the earnings per share that sits at 5.46, and compared to the industry average, it still shows that the business is quite profitable. However, it's a bit less than industry average. Now if we look at the price earnings ratio, which is focused on the trailing 12 months, it sits at 12.53 compared to the industry average of 8.7. This means that the stock has good potential for growth, and investors will typically spend $12.53 for every generated dollar of annual earnings. Now, trailing 12 months simply means the last 12 months, okay? Other ratios looked at was the long-term debt to equity and the returns on equity, which shows a 32.69 and 13.8% respectively. Now this reflects that the shareholders' equity can adequately cover the long-term debts, which shows some level of stability. And 13.8% returns on equity reflects a reasonable profitability of the business, which is of course better than industry average of 10.13%. Now when you assess profitability overall, you look at both gross margin and net margin, and we have 59.34% and 13.3% respectively, which reflects overall profitability of the business. So in terms of my own recommendations or my views, I would say this is a strong buy. So my second stock is Pembina Pipeline Corporation with the ticker symbol PPL. So PPL is a Canadian corporation that operates both transportation and storage infrastructure that delivers oil and gas to different parts of Canada. So Pembina owns an integrated network of hydrocarbon, liquids and natural gas pipelines, gas gathering and processing facilities, oil and gas, natural liquids and infrastructure, and overall logistics services for oil and gas. It also has a growing terminal export business. So PPL operates through three major segments: pipelines, facilities and marketing, and new ventures. Now let's take a high-level overview of what Google Finance says about this stock. So PPL trades on the Toronto Stock Exchange at the price of $41.29 and has a market capitalization of 22.76 billion Canadian dollars. Now let's go deeper into our analysis. As you can see from my screen, it has a dividend yield of 6.47%, which is greater than the industry average of about 3.51 averagely. Now, for every $1,000 in this stock invested, you should be getting about $64.7 per annum. A dividend growth of 3.57% and a dividend payout ratio of 59.81%. Now, this implies that the business is reinvesting most of its profits for continuous growth in the future. Now, let's look at other parameters or ratio analysis, which I've also done. Now, when you look at the current ratio for June 2023, it sits as a comfortable 0.62, which is pretty close to the industry average. Now, when we look at the share price, we can look at earnings per share and the price earnings ratio, which sits at 4.85 and 8.48 respectively. Now, this reflects that the business is quite profitable and better than the industry average, of course. Now, the stock's potential for growth is minimal and quite lesser compared to the industry. However, investors will still be willing to spend up to 8.48 for every generated dollar from this business. Now, if we assess based on funding ratios, we can look at the debt to equity as well as returns on equity. Now, you can comfortably see that we have a 64.0% debt to equity, which means reasonable borrowing for funding operation. And of course, shareholders' equity can comfortably cover the long-term debts in this case. Now, a 19.28% returns on equity reflects a reasonable profitability of the business and better than industry average of 4.85%. Now, let's look at other parameters for profitability, such as the gross and net margin. Now, we have a 24.71% TTM. TTM means trailing 12 months, and a 28.48%, which is pretty reasonable in relation to the industry's average. This implies that this business is quite profitable as well. So in terms of my recommendation, this is a buy for me, of course. So my third stock is Bank of Montreal with the ticker symbol BMO. So BMO operates in the financial services industry and is Canada's oldest and third largest bank. So BMO offers services such as personal and commercial banking, wealth management, global markets, and investment banking as a whole. So BMO operates through three major groups: personal and commercial banking, wealth management, and the third is the capital market. It has an overall average asset base of $884 billion. So let's take a deep dive into the analysis of BMO stock price. Now, when we look at Google Finance, BMO currently trades at $119.44 on the Toronto Stock Exchange. And of course, it has a market capitalization of 85.31 billion Canadian dollars and a P ratio of 11.87. So if we look at the deeper analysis of BMO stock as a whole, you can see that the dividend yield sits at 4.95%, which means that for every $1,000 you invest in this stock, at the current price, you should be getting about $49.5 per annum, and your dividend growth of 31.13% and a dividend payout ratio of 35.48%. And of course, the lesser the payout ratio, the more funds are available for investment in the business growth. Now, if you look at the liquidity ratio, we have the current ratio and quick asset ratio. The quick ratio sits at 0.32, which still reflects some sort of liquidity in the business. So with respect to the earnings per share and the price earnings ratio, we have 9.97 and 12.4% respectively, which is pretty close to the industry average of 10.79 and 9.59 respectively. So this means that the stock's potential for growth is better than the industry average, and of course that reflects in the price that investors will be likely willing to pay for this stock at the $12.4. Now, when we look at the gearing and funding ratios, such as the debt to equity and returns on equity, we can see a 40.41% and a 10.14%. Now, because the 40.41 is pretty low compared to industry average, it reflects that the business is low geared. Also, when you look at the net profit margin here, it sits at 23.87%, which means the business is overall profitable for anybody's assessment or investment. So in terms of my view on this stock, it's a buy for me. So my fourth stock is the Canadian Natural Resources with the ticker symbol CNQ. So CNQ is an independent crude oil and natural gas exploration, development, and production company set up in 1973 in Calgary, Alberta. Now, CNQ holds the top position as Canada's leading crude oil producer and stands as the largest independent natural gas producer. The company has over 9,000 employees and its stock is a key constituent of the S&P index. By the way, S&P stands for Standard & Poor. Now, when you take a look at Google Finance, you can see that CNQ trades on the Toronto Stock Exchange at $81.51 and it has a market capitalization of 89.19 billion Canadian dollars. This stock has significantly grown from its price of 45.73 in 2018 to 81.51 currently in 2023, which is about a 78.24% increase in the stock price. Now, if you take a look at the analysis of this stock, you can actually see that it has a dividend yield of 4.42%, which is above the industry average. That's to say, for every $1,000, you should be getting about 44.2% per annum, a dividend growth of 108.51%, 27.26% for its dividend payout ratio, which means that it invests more than 70% of its funds or profits in the growth of this business. Now, if you take a look at other ratios such as the liquidity, which includes the current ratio and quick asset ratio, you can tell that 0.7 and 0.4 shows some sort of liquidity in the business. Typically, I look out for businesses around 1. However, it reflects that many businesses within this industry sit at a lower liquidity ratio, which means that they don't have funds just held. They probably have it invested in several areas such as maybe pipelines and equipment. So the downside to low liquidity is that when short-term liabilities become due, it becomes really hard to make payments, and then the business will probably have to look for alternative sources to make those payments or settlements. Now, this can lead to raising additional capital, and this might stress the business even more than you think. So when we look at other factors such as the earnings per share, price earnings ratio, it sits comfortably above the market or industry average. Now, this shows that the business has a good potential for growth in the long term. And this is reflected in how much investors will likely pay for this stock at $11.76 for every dollar generated as annual earnings. Now, if you look at the gearing ratio, such as the debt to equity, it's a 25.45%, which shows that the business is not highly geared, it's kind of low geared, and the returns on equity of 19.48%, which means there's more returns on your investment in this stock. So if we look at the profitability of this business using the gross profit and net profit margin, we can tell that 20.72 to 50.2% reflects some sort of profitability of the business overall. So my fifth stock is Toronto Dominion Bank, which trades with the ticker symbol TD. Now, Toronto Dominion Bank is a financial institution that was founded in 1955 and has its headquarters in Toronto, Ontario, Canada. TD operates through 4 major segments, which includes Canadian personal and commercial banking, US retail, wealth management and insurance, and wholesale banking. In its personal and commercial banking segment, it offers services to over 15 million customers across Canada. So let's take a deep dive at the analysis of this TD stock on Google Finance and my own analysis. As you can see from my screen, TD Bank trades on the Toronto Stock Exchange at $86.40 and it has a market capitalization of 157.66 billion Canadian dollars. So let's look at the financial ratios of the TD Bank stock. Now, TD Bank has a dividend yield of 4.44%, which is above industry average, and a dividend growth of 12.66%, and a dividend payout ratio of 32.68%, which means that this business reinvests more than 65% of its profits back to the business for growth. So if we take a look at other ratios, such as the current and quick asset ratio, we can tell that this business has pretty low liquidity. Now, pretty low liquidity could simply imply that this business has funds tied in many investments. Now, it may not always be a bad thing when investments are tied. However, when short-term liabilities become due, it becomes a bit challenging to make those payments. So if you look at other factors like the earnings per share and the price earnings ratio, we can see a 9.48 and 10.92. Now, this is pretty much close to industry average, which shows that the stock has good potential for growth in the long term. Okay. Now, when we look at the gearing of this business, we look at the long-term debt to equity and the returns on equity. It shows that the business is quite geared because you can see a 153.58% that reflects that the debts exceed the equity by over 53%, which further explains that the shareholders' equity cannot adequately cover long-term debts. The returns on equity of 14.01% still feels fair to me if you ask me. Now, when we look at profitability of this business, a 30.3% net profit margin shows that the business is overall doing well. So in terms of my decision around this stock, I would say it's a complete buy for me. Now let's take a summarized overview at all the stocks that we looked at today. We can compare all the 5 stocks based on dividend yield, the growth, and the dividend payout ratio for you to do a further analysis if you wish to. And you can see from here that it all sits pretty fair for anybody that is looking out for dividend stocks. So these are good dividend stocks as well as growth stocks. Now, when we look at other things like the liquidity of the business as well as the profitability and the debtedness, you can also make your decision around all of this when you compare all these 5 stocks overall. Alright, those are my 5 selections. I hope you enjoyed it, and if you have any questions, feel free to drop in the comments, or if you have a different view or perspective from what I've given here, feel free to also drop that in the comments, and I'll be happy to address your questions and of course deliberate further. Thank you, and see you at the next video. Bye.